For Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
Good afternoon, Bruce.
How you doing?
I'm doing awesome. Welcome back to the real world.
Thank you very much for all of our listeners out there. I just got back from a cruise, so I'm on cruise mode right now. So I've got to get back to reality today. But we got a lot of things to cover. And what we're getting a lot of calls on right now, Tom, is since the market's becoming more competitive and the competitive offers are becoming more frequent again as rates continue to settle.
Sure.
We're seeing people that are really toying between FHA loans and conventional loans. So we really need to discuss the advantages and disadvantages. Now, if we don't have enough time to cover the disadvantages in this segment, all of you that are listening, we will pick it up on the next one. So you won't want to miss that. So let's kind of cover this. All right.
Yeah, absolutely. So we talked about credit scores, right? We know that credit score is important for how you get qualified and what rates you get. So
yeah, you're right, Tom. Credit scores are important no matter what kind of loan you're getting. It doesn't matter if it's FHA, VA, or conventional. The better the score, the better the interest rate that you're going to get. But when it comes to flexibility in credit scores, FHA is hands down much better transaction, much better loan for someone that has marginal credit scores. Matter of fact, at Cross Country Mortgage, we don't even have a credit score requirement for FHA. We don't have an overlay, so to speak, meaning that if it's approvable and we are direct through FHA, if it's approvable, we'll do the loan. We don't care.
Right. Yeah, I know some lenders do say, hey, you got to have a 600 or a 580 or 620. And
Yep.
Yeah,
So FHA does require that if your credit score, middle credit score for the lowest of the borrowers is less than 580 or 580 or less, that they must put down 10%. That's an FHA guideline.
Okay, fair enough. So if I've got a credit score below 700, most likely you're going to want to push me into a FHA loan. If I'm over 700, then I may go conventional. It may
that's an interesting statement. So first thing we always want to do is look at what's best for the customer, because listen, you might have a 690 credit score, but you got a 25 back end debt ratio, a low housing ratio or overall ratio, and it still might work. And that way we can give the client the option between the two. But typically, actually, when you're below 720, the mortgage insurance is what becomes the problem. The interest rate can be problematic if your scores are low, but the mortgage insurance starts to get really high.
Gotcha. All right. So debt ratio. So now this is the overall debt ratio, right?
This is the back end or overall ratio, including the housing and all of your other expenses. When you start exceeding 45%, FHA may be a better option for you. Now, that doesn't mean you can't go to 50% on a conventional loan. You can with good scores. But when you're challenged and debt ratio is a problem, then FHA is generally going to be a little bit more friendly than a conventional loan is when it comes to your approval.
Got it. Okay. All right. And then, and by the way, we've talked about these things, right? You said underneath there, we've got FHA is easier to qualify, lower rate and lower PMI. And by that, we don't mean in general, we mean specifically in these cases, right?
That's correct. That is correct. We are talking about in these cases.
That's cases.
Right. So nothing is always in this business. There's always something that can cause you to go in one direction or another. But again, isn't it important that you just know your options? That's really what it's all about.
I used to be an engineer, and in engineering, we always used to say the answer to everything is maybe. So,
yes.
so multiple occupations. So I find this one interesting because, I know people can switch jobs. If you're a nurse and you go switch hospitals and you're still a nurse, that's not switching occupation.
Makes no difference when you do that. But when you are a bus driver and now you're a teacher and then you go to be a server at a restaurant, when you have multiple occupations within a 24-month period, it can start to get problematic, and FHA can be much more friendly to things like that.
Right.
So again, it's always maybe but generally FHA, and listen, well, a lot of people don't understand is FHA is not just for first-time home buyers.
I think that's a big misconception.
It is only for a primary residence, but it's not for just first-time home buyers. We do a lot of loans for people that need FHA for a variety of reasons. The ones we just cited, maybe their debt ratio is high or their credit scores aren't as high as you want them to be. And FHA turns out to be a better deal.
And you can only have one FHA loan at a time, right?
You know, that is almost true. It's one of those maybes again, right? So the answer to that, the quick question is yes, but not always.
Okay.
So there are circumstances where if you are being relocated with your company at their request, not your request, and it is 100 miles away from your current residence, then you can get an exception.
Wow,
but that's the only time. Yeah.
All right. Fair enough. Always an exception. All right. So 1099. Now this was an interesting one when you brought this up. Because I thought that you had to have 1099. If you were a 1099, you had to have 2 years, not only of income, but of tax returns, right?
Well, this is true. This is true. So, however, FHA has a little bit more flexibility when it comes to that. So I'll give you an example. I've got a nurse. She's been a nurse for 10 years.
Mm-hmm.
She went 1099 1 year ago. Everybody was turning her, still a nurse, but she's 1099. Now, she had to complete her tax return. So you're correct about that. But I only have 1 year of 1099. So I'm able to use that income because I'm being able to provide evidence that this is her same occupation.
She's getting paid.
So it gives her more flexibility. Conventional, you might be able to do it with 1 year, but the lender is going to have to average that 1 year over 2 years. And then what's that going to do to your income?
Right. Gotcha. Okay. Fair enough. All right. So lower down payment for lower credit score. So if I have a lower credit score, I can still pay a 3.5% down payment.
You can. Yeah, you can. So, and in our next segment, we'll talk about, you can still do low down payment loans on conventional loans.
Right.
But you got to start walking on water when you're putting 5 or even 3% down on a conventional loan. FHA doesn't care. As long as you're over that 580 score and you're qualifiable and the risk levels, don't exceed tolerances, FHA is going to be a lot easier for you to do. So, and I want to talk to you, we've got a couple, I think more of these, but I want to talk to you about the perception in the industry, not just the reality, because we deal with both in our occupation, don't we?
Yep. So yeah, I mean, I know as a listing agent, I know that a lot of sellers and a lot of agents think that FHA loans are only for people that are struggling or for first-time home buyers. And I know that's not always the case.
No, it's not always the case. Matter of fact, you can have a very strong borrower that an FHA loan just suits them better. It's more flexible in so many more ways. And it does not mean that they're less qualified. The thing that determines whether a borrower is more or less qualified, even on VA, and we'll talk about VA in a future segment, but even with 0 down payment, I can show you how that buyer may be stronger than a 20% down conventional a borrower. It can happen. And it's not that infrequent. It happens frequently.
Well, that's what, as a listing agent, if I'm in a multiple offer situation and I have a bunch of offers, I go vet the lenders and I talk to them about the person and how well qualified they are and what the process is going to be and all those kind of things. And that tends to give me a better feeling about going with, a particular FHA buyer over, a conventional.
Yeah. So everybody out there that's watching this right now, including real estate agents, the important thing that Tom's talking about is vetting the loan officer. And here's the thing. Unfortunately, there's a lot of loan officers out there that will shoot first and ask questions later. It's a
Yeah,
problem. It truly is a problem in our industry. And it's unfortunate because, in my opinion, if you pre-approve somebody, then you should stand by your pre-approval unless they lost a job,
right.
or
Something
something
changes.
significant happened. But what happens is a lot of these loan officers and banks they'll be like, well, I pulled your credit and you told me what your income was, and I'm going to shoot you over a pre-approval letter. They haven't seen one document other than
Right.
a credit report, and it's just, to me, that's malpractice. So the idea here is that you need to vet the loan officer, and I created a questionnaire for real estate agents that's called an interview with a loan officer, and that does not mean you interviewing me. It means you determining whether the letter that I wrote is worth the paper it's written on. So what I do, and this is what I do for Tom and his borrowers, when you come to me, I don't care if you're FHA, VA, or conventional, I will put you through a pre-underwrite if you're out looking for property, meaning I've already got an approval on your loan. Most pre-approvals, matter of fact, all pre-approvals are written by the loan officer. Now, I don't know. Can you ever remember, Tom, a loan officer ever approving a loan? It doesn't happen. Loan officers can't approve loans. Underwriters approve loans.
Correct.
So if I pre-underwrite your loan, I don't care if it's FHA, VA, USDA, or conventional. I will guarantee the seller that I will pay the seller up to $500 a day for every day that I miss the closing. I'm not going to miss the closing.
No, you're not. All
Yeah.
right. So let's see. Let's go to the next one here. We got this is a nice advantage. Now, it's not an advantage when you're buying, but it's an advantage later on down the road if you decide to sell. With today's interest rates, what are we in the mid
The
sixes?
door's ringing.
We're in the mid sixes to low sevens, right?
Yeah, we're in the mid sixes to low sevens right
Yeah,
now.
those aren't like phenomenal rates that people are going to want to assume unless in 2 years rates are at 9 and 10%. Then all of a sudden 7% looks really good.
It does. It absolutely
So,
does. And,
yeah,
rates are settling. I know this is not the forum right now to talk about what's going on this week, but I'm going to tell you, I'll give you a short thing. We got CPI coming out. We got unemployment coming out. There's a big bond sell off from the federal government this week. And then at the end of the month, we've got the Fed report. So I'm telling you, things could get a little rocky this week. I'm locking a lot of folks in right now just to hedge against potential bad news.
I know. We just locked ours last week with you. So, all right.
Well,
So we got one more FHA advantage, and that is the shorter waiting period after financial hardship. So
right. So
if
if
I
you
have
had a
this loan and I get in a little financial trouble, whether it's bankruptcy or anything else, right? Getting
so
getting an
bankruptcies,
FHA.
foreclosures, or short sales have a much lower waiting period.
Got it.
And like for short sales and bankruptcies, you're like 2 years. For foreclosures, you can be 3 years. And there's also forgiveness programs for extenuating circumstances. Conventional really does not have any extenuating circumstances. You either meet the time frame or you don't.
Or you don't, right? All right. Well, hey man, we got through all the advantages of FHA. What's the number? We got a minute left. What's the number one disadvantage of an FHA besides what we talked about earlier, where they're not looked at as favorably unless
PMI does the MIP or PMI does not go
PMI.
away.
Yeah,
It's
So
forever. It doesn't go anywhere. It sticks with you for indefinitely.
that's a good one right there. That's definitely a disadvantage. So if I'm putting down 3.5% and I've got a $80 to $120 a month PMI payment, doesn't matter if I pay that loan for 5, 7, 10 years, that PMI never goes away, even if I go up above 20% of equity, right?
That's correct. So that's the time to refinance. So the
Yeah.
idea here is that if you're getting an FHA loan, don't not get one because of the PMI. Get one, will refinance you out of it. But the idea here, Tom, is if it's a credit score issue, fix the credit score issue.
Yep.
If it's a debt ratio issue, fix the debt ratio issue. So when you want to get rid of the mortgage insurance, you're in a position to do that.
That's fantastic. Well, hey, Bruce, this has been a great segment, and I'm glad you're back.
Back
And
in one piece.
Yeah, yeah. I wanted to.
Yeah, I got a little conch in my blood right now. So
There you go. Want to remind everybody to subscribe to Bruce's channel and mine. I'll put mine up here shortly. But
and Tom, you can help anybody in any state in the United States as
that's
well as
right.
I can.
We're in all 50 states. Bruce, I got a boogie, man. We're hitting 15.